Hi, welcome back to this mini video series where I help you build a financial spreadsheet from scratch. If you haven't done so already, please go back and start with the first video. In this video, I'm going to be introducing the compound annual growth rate, or the CAGR, and explain the difference between that and the average annual growth rate. This is frankly something I should have done when I introduced risk to the financial model a couple of videos ago, but I forgot. So there you have it. My name is Lars Kroyer. I'm a former hedge fund manager who's written a couple books about finance, and I'm now doing these videos as a hobby. I'm not a financial advisor, so please make sure you do your own work before you do anything I say in this or in any other video. But let's get back to the spreadsheet. So here we are back at the old spreadsheet. I want to start by pointing out a mistake that a couple of very observant readers had found in the spreadsheet. If you see down in the data table in the both adding retirement and adding scenarios case, you see the data table here refers to cell number F9 up here. It should have been F8, which is where the standard deviation was. It ends up not actually mattering because we're using a random function, and the important numbers, the input here, the 25% that we have in column B, but good catch in any case. But as before, I want to start by just creating a copy of the sheet, so we get a new sheet for every video, and let's call this adding CAGR. So adding CAGR, this is super critical. What we saw in the earlier video when I added the risk to the model, I kept using the old compound annual growth rate of 5%. In reality, I should really then, I simply forgot, but I should have changed the number so that we used CAGR for the whole period, but for each individual year, we should have used the average annual growth rate. So let me go back to this. Let me do this almost by proof by example. Let's create a cheat sheet. And then just I'm gonna just make this, copy these cells. So I find it easier to copy some cells from elsewhere than to reformat it. Slightly lazy. So I find it, for example, easier to copy in 50% and call it 5. But so here, let's make this copy. Let's do this for 3 years. So what I want to see is if you start with this 1 plus the growth rate, and you copy this down, you see what we would end up with. So let's say, what's the average growth rate? Well, this is simply the average of the year, which is going to be at 5%. But then what is the CAGR, the compound annual growth rate? Compound annual growth rate. And what that is the ending year divided by the starting years to the power of 1 divided by the number of years. So 1 by 3 minus 1. So this is what you make every year. In this case, it was also 5%. But I want to show you something kind of interesting. So let's call this case 1. Now let's do a case 2. Let's just copy the whole thing. Actually, let's copy also the calculation, so we don't have to even copy those over. Case 2. Now let's make this, for example, 10%, 10%, and then minus 5%. What you see is, again, the average is 5%, but now the CAGR is lower. So the idea that the risk of each individual year introduced a lower net effect. Now, of course, we care a great deal about what the ending number is. That's actually the main thing we care about. And what we see is that although our annual average return was the same, the amount we made from start to finish on an annualized basis was lower. This will become even more obvious if we introduce far more extreme cases. So let's call this case 3. And let's say we do 100% 1 year, then we do minus 50%, and then we would have to do minus 35%. So now we see that the average was still 5%, but you actually lost money. Your compound average annual growth rate was negative 13%. So that's I hope you're appreciating that this is super important stuff. So when we talked about the average equity return, we're talking about they had a compound annual growth rate of 5%-ish. The average growth rate in any one year, if you looked at the markets in any one year, would have been higher. This is also important because it's quite confusing in a lot of the sort of marketing talk of financial products. These three this third guy can easily say, well, I return an average of 5% a year. To which the counter is, yeah, but if I'd given you money and asked how I was doing after 3 years, I would have lost money. So I don't care that the average return is 5%. I care about the compound annual growth rate. This is super important stuff. So how do we get? So let's go back to the sheet here. Well, because what we want to get is really what we want is obviously to figure out from start to finish how we were doing. So let's do a couple of cells here, and then I'll take this up one, and then I'm going to copy this. So this is the CAGR. So this is CAGR. Let's say that minus that. And so that's the same as before, right? Now what we want is what is the average, the annual average return. And there you go, annual average. Now here's the formula for that. I recommend that you Google how this is done if you're not clear, but it's basically 1 plus the CAGR squared plus the standard deviation. As you saw before, the higher the standard deviation, the bigger the difference. Squared is equal to 1 plus the average return squared. So if we wanted, so there you go. So this is the 1 plus the CAGR squared plus the standard deviation squared equals 1 plus the average return squared. So if we want to figure out, if we want to solve for the average return, we can do it as follows. So this gets a little complicated, so please try to stay with me. So we need two parentheses. It's 1 plus this guy squared plus the standard deviation, which in this case is 25%, squared. And then if we do the square root of that whole thing, so that's to the power of 0.5, that should get us that. Oh, we got a minus. 1 plus F7 squared, F10 squared, we got a minus 1. Well, that looks wrong. So let's see here, let's add. So that is clearly 7. Oh, I forgot to the power of 2. There you go. So that's right. So let's copy this into the minimal risk. So what we see now is that the minimal risk asset, there's no difference because there's no standard deviation. In the return, annual average return, the difference is about 3%. So the CAGR is 5, the annual average is almost 8. What we'll see if we change the standard deviation to, for example, 15%, the difference would be smaller. If we made this 0, there would be no difference, right? So that kind of makes sense. So this is important because what we see out here in the equity return, they depend on the annual average. What are you expecting in any one year? And if you have a CAGR of 5% and a risk of standard deviation of 25%, your annual average would be about 8. So I know this is tricky stuff, but it's critically important. Also, next time someone tries to tell you, if you go back here, try to tell you that they make an average of 5% or 10% per year, you should really ask them what their CAGR, or their compound annual growth rate is over a long period of time. So only one last thing, this is really cleaning up stuff. But what we should also emphasize is that this case here is really the engine of the model. The main case really is in all the iterations. Main case, or you can call it the calculated case. But really what we care about is, I want to move this out of there, what we really care about is what happens this, not if you do it one time, but if you do this 1,000 times. So make this equal to this. So now you see these are all the iterations. So call this with output, scenario output. We could call it that, which sounds good. So, oops. This is the underline. Let's make it bold. So this is really the core of the model. So, so there we are, and now we've incorporated the CAGR correctly. We're saying 8% a year. What you see is, let's do just one recalculate of all of this, and what you see is that the numbers are now substantially different than they were before. You see the mean number is 800,000. It's going to vary every iteration. It's not going to vary that much because we're doing it 1,000 times. You see every time I press it, it does change, but it doesn't change dramatically. So call that round about 775,000. In the case before, we saw the mean down here was 467. Press that a couple of times, we'll see it change a little bit. But obviously it makes a material difference that in any one year, we expect, instead of a 5% return, we're expecting an 8% return, which is the right number for this calculation. So thanks for watching. I hope that was interesting and useful. You can subscribe to my channel if you want to hear about future videos. Or share this video with your friends on social media if you think they would benefit from watching it. But in any case, I hope to see you in the next video.